From WBRN Radio, this is Numbers Man on the 15th of December 2015. This is a special report. The Trump presidency and the economy. There were a few analysts and analytic houses that gave the impact of the Trump election on the day after. Where these analyses were adequate for that time, we decided we would wait. And what we're doing here is using as a backdrop or backcore the report of the Fed. The Fed met on Wednesday. They raised the interest rate 25 basis point to 0.75. At the conclusion, Chair Yellen gave a news conference. That will be our starting point. And we'll get into one of the major issues she talked about, a term that is not that familiar to many people. We had to look at it. What happens occasionally, you forget things that are in the past. Hysteresis. Hysteresis, of course, is... in unemployment hypothesis is postulated that cyclical fluctuations have permanent effects on the level of unemployment. According to Blanchard and Summers, this is Larry Summers, the proponents of hysteresis recessions can have a permanent impact if they change the character or attitude of those who lost their jobs as a result of recessions. According to this hypothesis, persistent high unemployment leads to increase in long-term natural rates of unemployment, which is determined in the labor market. Unemployment may continue to persist due to strong labor unions that tend to maintain higher wages, therefore reduce employment. On the other hand, hysteresis is unemployment may also be caused by the anticipation of inflation, according to the Phillips curve. Dr. Yellen is a disciple of the Phillips curve. I am not. Downward pressure on inflation leads to sustained high unemployment. Accordingly, increases in actual unemployment need to decrease inflation may lead to an increase in the natural rate of unemployment and long-term lasting unemployment costs. We had that under Chairman Volcker. For those that recall, the rate of inflation was very high in the late 70s and early 80s. If hysteresis is wait a minute here. Yeah. Holds then the unemployment dynamic tends to be non-stationary or unit root process. This is what hysteresis does. This does not invert. Does not invert as long as it runs equilibrium. It has an important policy implication. High levels of unemployment, if left unattended by the government, may persist and continue to be a serious social and economic problem. If the unemployed ones are unemployed for such a long time, they lose valuable skills that's been brought out and become in place and therefore remain unemployable. The unemployment has a negative effect on economic growth and social stability, individual self-confidence, etc. That was from Blanchard's study there. What we're looking at here wait a minute, just a second. Hysteresis. Well, there's not. Anyway, nonetheless, this was a study done in 2009. And this theory has been around for quite a while. Hysteresis and the meaning of it, prolonged unemployment. The unemployment rate exhibits hysteresis, then it follows a statistical non-stationary process. We'll put this up on then the expected value of the unemployment rate now and in the future permanently shifts when the rate itself changes. The process with hysteresis is a unit root process in which in its simplest form it can be characterized as U1 equal T equal U1 equal E1. There, U is the unemployment rate, where at the same time F and E1 is a stationary error represented outside of the shocks rate, and according to the characteristic, we'll put the formula up there. The causes with some negative shocks reduce employment in a company or an industry. There are few workers left, and as the employed workers usually have the power to influence or set wages, this is something that, and they reduced number of incentivize them, to bargain for even higher wages. And when the economy again gets better, instead of letting the wages stay at equilibrium wage rate, where the supply and demand of workers would match, this causes hysteresis, i.e. unemployment becomes permanently higher after the negative shocks. So this is something Chair Yellen emphasized, and we thought we would clear it up a little bit, what hysteresis is here, and you'll hear in the Q&A, but it's only covered for about a minute, so not very much there. Let's go to the actual unemployment statistics themselves, and we'll, let's see. We'll get back. This is the unemployment situation here. This was released last week. This is for November. The unemployment rate declined to 4.6% in November. Total non-farm employment was 178,000 there. Thus, in 2011, this is from the Bureau of Statistics, employment averaged about 180,000 a month. You compared with an average of about 229,000 in 2005. So you see the hysteresis there. Employment in professional and business activities rose 63,000 in November and has risen by 571,000 over the year. Over the month, according to accounting and bookkeeping added 18,000 jobs. Employment continued to trend up in administrative and supportive services, 36,000 there. Computer systems and design, 5,000. Management and technical consulting, 4,000. Healthcare rose by 28,000. There were many of the critics of the Affordable Care Act said that the Affordable Care Act would kill the health industry. It has not happened. Within the industry, employment growth occurred in ambulatory healthcare services, 22,000 over the past 12 months. Healthcare added 407,000 jobs. Employment construction continues upward trend. A number of places that's happened in Michigan. We'll get to that in a minute. 19,000 with gains in residential specialty trade contractors, 15,000 over the last 3 months. Construction has added 59,000 jobs. Employment in major industries, including manufacturing, wholesale, retail, etc., changed a little over the month. The average work week for all workers in private non-farm payrolls was unchanged at 34.4. In manufacturing, the work week declined 0.2% to 40.6 there. In November, the average hourly earning for all workers declined by 3 cents to $25.89, following 11% increase in October. Over year, hourly averages have risen 2.5%. The average hourly private sector production non-supervisory employee edged up 2 cents to $21.73. Now on to the revision in the seasonal adjusted household data here. That will be out on the 6th of January 2017. Also, in February, we'll have the establishment survey data out. A few things a little incomplete here. Dive a little deeper into this. Won't spend a lot of time on it. Unemployment rates here, civilian, let's see, we'll get to the rates. 16 and over, 5%. Adult men, 20 and older. Let's get to it in November here. 4.3. That's of 16 for European Americans. 4.2. And for African Americans, 8.1. For Asians, 3%. And for Latinos, 5.7. And it's a little bit more involved here. Reasons for unemployment: job loss, a person who completed a temporary job there leaves jobs, 938 re-entries, 2009-8. Let me just check to see if this is obviously in, we assume, in the millions. Oops. Just a minute here. Yeah, we're in the thousands. Okay. And to make sure that what we're doing here, anyway, we missed out. Okay, in the thousands. Yeah, let's see. Yeah, well, new entrants, 793, and this is season-adjusted numbers in the thousands here in the year, the whole year itself. So we have that down, the average while they were leaving and what happened to them. Starting to get a much better data. What we wanted to talk about just a little bit here, and we'll move on very, very quickly, is the participation rate. That's something that you normally used to not see. And the reason is hysteresis, hopefully I'm pronouncing it right. From the BBC, their commentary was U.S. Unemployment rate fell to a 9-year low. That was from the Federal Reserve there, but what is 4.6 from 4.9. Statistically, that doesn't mean that much, because if you look at the stubborn sectors there, they remain just as that. Let me sort of round up where Chair Yellen. Well, we'll get Michigan. Michigan unemployment rate rises for the third month. November marked the first month in 2016 that Michigan's jobless rate was above the national rate. In the state of Michigan, a state that turned red, 4.9%, excuse me, was there, whereas the national rate we just got was 4.6%. So we're starting to see some rise, going the increase in number of unemployed over the last 7 months reflects a sizable entry of individuals into the state's workforce. Most but not all have found a job. That's according to the Bureau of Labor Market in the state of Michigan. Job sector recorded gains for the last 2 months. Construction jobs were up 6% in Michigan, an unusual situation for construction jobs. But nonetheless, they were out there, and they will no doubt continue to be out there. Let me see if we can get Chair Yellen. We just flew by that just a second ago. Here we go. Yellen and Donald Trump are on the same page for now, as from the Wall Street Journal. The market post-election euphoria, got a reality check Wednesday when the Fed raised their interest rate and hinted they have two more for the 2017. Historic tension between the presidents and Fed chairmen out there. The inflation rate, we talked about that at 2%. The Fed believes structural changes in the economy, if it can't tolerate the fund rate. They're looking even towards, and we've talked about that before here, 3%. Now, Yellen is in the Phillips curve. We talked about that just a minute ago. The unemployment rate falls below the natural rate. The scarcity of labor and other resources push wage prices higher. Fed officials put the natural rate at 4.8% in November. Actually, the unemployment rate dropped below that level to 4.6, which statistically really doesn't mean that much. Yet the officials see the jobless rate averaging even less at 4.5 for the next 3 years. Now, 4.5 is quote-unquote the natural rate, whereas in the 60s and in early 7s, Arpa Occam and those people, we looked at something like 2.5% as a rate. So you can see what has happened here in terms of what levels of unemployment is actually tolerated. The Fed target overnight fund rate is 1.37 by the end of next year, only marginally from the 1.31 in September. Now, the Fed tends to see bad news as a reason to delay tightening. We talked about that, is also inclined to let the unemployment rate test its lowest bounds. And on Wednesday, she emphasized that she wouldn't allow any such experiment to push inflation above the target rate. Well, there's been a lot of talk about that. If you wake up tomorrow and the central, in every central bank in the world raised interest rates by 300 basis points, the world would be a better place. Now, that is from the Goldman Sachs and Gary Cohen there, soon to be the director of Trump's National Council of Economic Advisors. Trump, coming out of a real estate background, has always preferred higher interest rates and how to deal with them, but other sectors of the economy don't do as well. Trump's campaign attacked President Obama didn't prevent the two from developing a rapport during the election. His administration's relations with Yellen likely would depend more on her job performance than her party affiliation. She made very clear in her press conference that she will remain her 2 years there, and they're staggered 4-year terms with the president. Now, Cohen, after all, is a Democrat. Didn't know that. Trump's pick for Treasury Secretary has said Yellen has done a good job, Dr. Yellen, and likely Trump will likely name a Republican. That's in 2018. I didn't know Cohen was a Democrat. Well, he comes nonetheless from where does he come from? Had it here just a minute ago. Goldman Sachs. All right, let's merrily along here. Money.com. Fed not predicting a big growth spur, as it says here. Trump's, when pushed, Yellen, you'll hear this in a minute, proposal of a $1 trillion infrastructure spending plan is even necessary. I would say at this point that fiscal policy is not obviously needed to provide stimulus to help us get back to full employment, she said, although she added that she wanted to be clear that she's not giving policy advice to Congress or the president. Fed chairs don't do that. She wants to revisit Dodd-Frank. Trump has made contradictory remarks there, yet Yellen whether he thinks the Fed should raise interest rates now. He said he's not an enemy of Yellen, but he also still, like most critics of her and the Fed, keep rates almost at zero for so long. They would like to see the rates go up. The Fed and the White House have had battles before. That was when George H.W. Bush blamed Alan Greenspan for costing him the election. Well, we'll see there. Hard to say. Trumpnomics, this is in a Money Wall Street. This is what a big thumbs up. Well, for now, big banks, Bank of America, HSBC, are bumping up their predictions for U.S. growth, stock market gains. The reason Trumpnomics, following Trump's election, we have altered our GDP forecast, and we are now expecting a modest fiscal stimulus from lower taxes and higher government spending. And that is interesting there, because we've been in austerity. It's a stunning revival from the days before the election, when economists and market experts, many Wall Street banks, were forecasting dire consequences. A recession swept market drops. Well, there was a temporary drop, but it got up. They know where the bacon is. The market has surged to record levels. That's a little bit shaky there. Anyway, nonetheless, promised mass tax cuts for individuals and businesses, a rollback in the ominous regulations, up to $1 trillion of new government spending on roads, bridges, and infrastructure. The Dow is up, for 5% for this month. The market has sailed through the scoring of this year's big shock. That's Basics. On top of the tax cut, investors also like the idea of giving big businesses like Apple a tax discount to bring the cash home programs. Wall Street newfound love for Trumpnomics comes with an asterisk. Trump can't get too protectionist on trading, some say. Wells Fargo put it this way: tax cuts and additional federal spending could stimulate economic growth, but tariffs and restricting immigration may slow the economy. Visa policy prospects create potential offset effects due to trade concerns. Wells Fargo hasn't hiked its GDP forecasts. So this is what some banks, Bank of America, Merrill Lynch, ended the shift, around expecting lift in the forecast to, this is a Wall Street 2010 from 2000, raising our GDP forecast. This is HSBC from 2.3% to 2.3%. That's not very good. From 2.1%. We forecast the average GDP growth in 2018 2.7%, up from 2.2%. GDP is likely to accelerate next year if a new fiscal policy regime, corporate and household tax cuts. But will that go back into the economy is a big question. Capital economics. Now, let's see. We expect GDP growth to accelerate to 2.75 next year, up from 2%, with the CPI inflation climbing towards 3%. Interesting. A key message of the market recently has been, this is from Strategics, yeah. Anyway, something to single party government maintains it's possible that a well-executed U.S. fiscal policy could boost growth substantially, plus 1% GDP in 2018 and 2007. Well, that'd be interesting. It would be interesting. Trump has talked about 3.4, 3.5, and now it's a 1% increase in GDP with all of his stimulus, all of his tax breaks, all thrown in, his job creation schemes, and we wonder if that will in fact help the situation or not. From the Business Insider here, well, we had 0.75 here, so we don't really worry much about that. The Fed release. We will have This Week in Economics, so we'll get back to some of this. 3 hikes in 2017 here from the Chicago Tribune. And from James Marble at TD Bank said the Fed's forecast of 3 increases next year, up from 2, was only real surprise. Well, what the Fed is doing here, the Fed is anticipating if Trump does deliver on some of his jobs. He's evidently got a job creation program. If we are to look at what happened with the manufacture in Indiana, roughly were 1,000 jobs at stake there. Trump supposedly saved about 50% with heavy tax incentives there. Now, that was a part of United Technologies, so a little bit different there. So in the event those jobs are created, the Fed will be ready to boost interest rates to keep the economy from overheating. That is where that stands to be. Let's see, Greg McBride at bankrate.com. This single point more in interest rates will go largely unnoticed at household level, but coupled with last year's hike, the cumulative effect could mount quickly if the Fed quickens the pace of rate hikes in 2017. Now, mortgage rates have actually went up, and that's an interesting situation within itself. Some investors appeared disappointed by the Fed forecast of free rate increases in 27. They closed down 118 points there. The yield on the 10-year Treasury rose to 2.57 from 2.47. So Treasury's up. People, no doubt, are buying Treasuries. And let's see what else we have here. The Fed's prediction, well, we talked about that, dropping the rate dropping to 4.5% by the end of 2017. Not much. It's at 4.6% now. And economic growth reaching 1.9 this year and 2.1% in 2017. Some expect it to grow a little better than that. Now, the central bank long-term estimate for economic growth at 1.8, below the 4% that Trump has said he could achieve from his economic program. Now, he has sort of waffled on that a bit. He's talked about 4%, and then he's 3.5%. I'm not sure where he is now, 3.4%, sort of up and down. This will conclude our report. We'll go on to Chair Yellen here, and as we started with some of the terminology here, in terms of the period where we are right at this particular period of time. Let me just see if we can grab this.
Who lost their jobs during the Great Recession, drop out of the labor force, and lose their ties and become discouraged and not re-enter. And I raised a question as to whether or not hysteresis could operate in the opposite direction. And that was a research question for economists to see if there is any evidence, because it could be important in determining policy. But I didn't draw any policy conclusions from that. And as I indicated, I think the path that you see that the committee has laid out in a tentative way that involves a modest degree of undershooting of normal longer-run levels of unemployment, going down to around 4.5%, where it would remain for a couple of years, might provide some insight. So I was not recommending a substantially easier policy in order to test that hypothesis.
Thank you. I guess my question that I had before that follow-up was, both times you've raised rates in this cycle, the market expectations of a rate hike have been over 50%. The market is...
Okay, that was hysteresis. I hope we pronounced it correctly this time. We did starting out. But nonetheless, the whole hysteresis, talking about a reverse of that, the longer people are unemployed, then the more stubborn it is to get the rates of unemployment down. Now, you go down, say, to 4.6%, but you will still have large numbers of people unemployed. Now, that particular number is up there. Now, it can be argued, okay, the real rate, the actual rate, not the natural rate, is closer to 10% when you get all the discouraged workers in. And this is what we talk about hysteresis. That number is very, very stubborn to get down. Nonetheless, good day, and we'll see you on this weekend on This Week in Economics. We didn't give the market reports, but we will summarize that. That'll occur on Friday night or Saturday or a late Saturday night that we'll have that on. Will be a little bit more timely. We are on, of course, iHeart. We're on Spreaker. We're on Stitcher. I'm sorry, not Snitcher. Anyway, nonetheless, we are there, and we'll look more at hysteresis, and we'll get into that particular item. We've been looking at unemployment, training. Does training tend to assist people that are long-term unemployed? What does technology have in it? The progressive economists, Marxist economists, have long talked about the use of capitalism and innovation. I think Marx called it typewriting. And with each innovation, some innovations out there, the disruptive technologies, end up employing people, displacing other people. We'll look a little bit at that as we end our year and see where we are. We have new things out there. New technologies that are coming out of, say, Silicon Valley and other places there. Thinking of some of the 3D type technologies there. But one of the persistent problems we've had, being in information technology myself, is that we employ small numbers of people. If you look at the factory in Indiana, at one time that would have been several thousand people. Now we're talking about, with administrative and other types of people, you have only roughly about 1,000 people there or less. And of course, technology will eventually take some of those people down, both in the clerical sector and in the other sector. Now, as to the moving of plants to cheaper economies, that is occurring, but new innovation will relieve some of the workers as you get more and more robotics in. Google now has their self-driving car unit there. They are competing against Uber and various others, and GM, Ford. Everyone is trying to get to the self-driving car, which will eliminate the Uber driver. So we're having those sorts of things happening out there, and how do we address those? Well, they are more and more going to have to be addressed by a national policy. Even at the fast food restaurants, we see that. So we'll talk a little bit about that, although it's not really in the field of macroeconomics, but micro. But at the same time, they have overlapping situations. A good day.
Half to 3/4%. In doing so, my colleagues and I are recognizing the considerable progress the economy has made toward our dual objectives of maximum employment and price stability. Over the past year, 2.25 million net new jobs have been created. Unemployment has fallen further, and inflation has moved closer to our longer-run goal of 2%. We expect the economy will continue to perform well, with the job market strengthening further and inflation rising to 2% over the next couple of years. I'll have more to say about monetary policy shortly, but first I'll review recent economic developments and the outlook. Economic growth has picked up since the middle of the year. Household spending continues to rise at a moderate pace, supported by income gains and by relatively high levels of consumer sentiment and wealth. Business investment, however, remains soft, despite some stabilization in the energy sector. Overall, we expect the economy will expand at a moderate pace over the next few years. Job gains averaged nearly 180,000 per month over the past 3 months, maintaining the solid pace that we've seen since the beginning of the year. Over the past 7 years, since the depths of the Great Recession, more than 15 million jobs have been added to the U.S. economy. The unemployment rate fell to 4.6% in November, the lowest level since 2007, prior to the recession. Broader measures of labor market slack have also moved lower, and participation in the labor force has been little changed on net for about 2 years now, a further sign of improved conditions in the labor market given the underlying downward trend in participation stemming largely from the aging of the U.S. population. Looking ahead, we expect that job conditions will strengthen somewhat further. Turning to inflation, the 12-month change in the price index for personal consumption expenditures was nearly 1.5% in October, still short of our 2% objective, but up more than a percentage point from a year earlier. Core inflation, which excludes energy and food prices that tend to be more volatile than other prices, has risen to 1.75%. As the transitory influences of earlier declines in energy prices and prices of imports continue to fade, and as the job market strengthens further, we expect overall inflation to rise to 2% over the next couple of years. Our inflation outlook rests importantly on our judgment that longer-run inflation expectations remain reasonably well anchored. Market-based measures of inflation compensation have moved up considerably, but are still low. Survey-based measures of longer-run inflation expectations are, on balance, little changed. Of course, we remain committed to our 2% inflation objective and will continue to carefully monitor actual and expected progress toward this goal. Let me now turn to the economic projections that were submitted for this meeting by committee participants. As always, they conditioned their projections on their own individual views of appropriate monetary policy, which in turn depend on each participant's assessment of the multitude of factors that shape the outlook. The median projection for growth of inflation-adjusted gross domestic product rises from 1.9% this year to 2.1% in 2017 and stays close to 2% in 2018 and 2019, slightly above its estimated longer-run rate. The median projection for the unemployment rate stands at 4.7% in the fourth quarter of this year. Over the next 3 years, the median unemployment rate runs at 4.5%, modestly below the median estimate of its longer-run normal rate. Finally, the median inflation projection is 1.5% this year and rises to 1.9% next year and 2% in 2018 and 2019. Overall, these economic projections are very similar to those made in September. GDP growth is a touch stronger, the unemployment rate is a shade lower, and inflation beyond this year is unchanged. Returning to monetary policy, The committee judged that a modest increase in the federal funds rate is appropriate in light of the solid progress we have seen toward our goals of maximum employment and 2% inflation. We continue to expect that the evolution of the economy will warrant only gradual increases in the federal funds rate over time to achieve and maintain our objectives. That's based on our view that the neutral nominal federal funds rate, that is, the interest rate that is neither expansionary nor contractionary and keeps the economy operating on an even keel, is currently quite low by historical standards. With the federal funds rate only modestly below the neutral rate, we continue to expect that gradual increases in the federal funds rate will likely be sufficient to get to a neutral policy stance over the next few years. This view is consistent with participants' projections of appropriate monetary policy. The median projection for the federal funds rate rises to 1.4% at the end of next year, 2.1% at the end of 2018, and 2.9% by the end of 2019. Compared with the projections made in September, the median path for the federal funds rate has been revised up just 0.25 percentage point. Only a few participants altered their estimate of the longer-run normal federal funds rate, although the median edged up to 3%. Of course, the economic outlook is highly uncertain, and participants will adjust their assessments of the appropriate path for the federal funds rate in response to changes to the economic outlook and associated risks. As many observers have noted, changes in fiscal policy or other economic policies could potentially affect the economic outlook. Of course, it is far too early to know how these policies will unfold. Moreover, changes in fiscal policy are only one of the many factors that can influence the outlook and the appropriate course of monetary policy. In making our policy decisions, we will continue, as always, to assess economic conditions relative to our objectives of maximum employment and 2% inflation. As I've noted on previous occasions, policy is not on a preset course. Finally, we will continue to reinvest proceeds from maturing Treasury securities and principal payments from agency debt and mortgage-backed securities. As our statement says, we anticipate continuing this policy until normalization of the level of the federal funds rate is well underway. Thank you. I'd be happy to take your questions.
Thank you, Madam Chair. Harriet Torrey with the Wall Street Journal. Why does the Fed now see 3 rate increases next year instead of 2? Is it because the economy is at risk of overheating, or is the Fed behind the curve, or is this a reaction to Donald Trump's election?
Well, I would like to emphasize that this is a very modest adjustment in the path of the federal funds rate and involves changes by only, some of the participants. So in thinking about the paths and the revisions, there are a number of factors that were taken into account by participants. The unemployment rate is perhaps a touch, as I said, a touch lower than previously. You've seen some modest downward revisions in that projection. For this year, there was a slight upward revision to inflation. And some of the participants, but not all of the participants, did incorporate some assumption of a change in fiscal policy into their projections. And that may have been a factor that was one of several that occasioned these shifts. But I want to emphasize that the shifts that you see here are really very tiny. Steve, and then we'll go to Jen.
Steve Leisman, CNBC. In recent testimony, you said your advice was for fiscal authorities to increase the productive capacity of the economy. Do individual and business tax cuts increase the productive capacity of the economy? And how would the Fed's reaction be different to fiscal policies that increase the productive capacity of the economy and those that don't?
So the statement that I made that it would be useful to increase the productive capacity of the economy reflects my concern that productivity growth has been very low. It's the ultimate determination of the evolution of living standards. Policies that would improve productivity growth would include policy changes that enhance education, training, workforce development, policies that spur either private or public investment to enhance the quality of capital in the United States that workers have to work with, and policies that spur innovation or competition or the formation of new firms. So tax policies can have that effect. It really depends on the specifics. I don't think there's anything that I could say in general about what tax policy would do, but and I really can't tell you what the Fed's response would be to any policy changes that are put into effect. I wouldn't want to speculate until I were more certain of the details and how they would affect the likely course of the economy.
Can I follow up? I'm sorry, but if there was a rush of fiscal policy that did not increase the productive capacity of the economy, would that mean the Federal Reserve would have to move more quickly with raising rates?
It's something I really just can't generalize about because, while it would be desirable to have tax policies that do increase the productive capacity of the economy, an increase in the pace of productivity change is one of the factors that does affect the economy's neutral rate. A boost to productivity could spur investment. As we've been saying, we estimate that the value of the neutral federal funds rate is quite low, and one of the reasons for that is slow productivity growth. And so it's very hard to generalize about it because it could affect that neutral rate.
Hi, Jim Puzangaro with the LA Times. For the average American, can you explain what the impact of this hike and 3 additional hikes will be next year? And should they feel more confident in the economy now that you are raising rates at a slightly faster pace?
So let me say that our decision to raise rates should certainly be understood as a reflection of the confidence we have in the progress the economy has made and our judgment that that progress will continue, and the economy is proven to be remarkably resilient. So it is a vote of confidence in the economy. As you know, this was a decision that was well anticipated in markets, and I think it will have relatively small effect on market rates. It could boost very slightly some short-term interest rates that could have an effect on borrowing costs that are linked to them. But overall, I think that households and firms will see very modest changes from this decision. But certainly it's important for households and businesses to understand that my colleagues and I have judged the course of the U.S. economy to be strong, that we're making progress toward our inflation and unemployment goals. We have a strong labor market, and we have a resilient economy.
Sam Fleming from the Financial Times. Clearly, there's been a lot of discussion already about fiscal policy, but even if you discount or don't know what the fiscal outlook is going to be next year, unemployment is already below the longer-run projection. Under the policy rule you cited in your August speech, that would suggest that policy ought to be tighter. Is there a risk that the Federal Reserve is already behind the curve even before any fiscal impact steps in next year? Thanks.
So I would agree that, and as we said in our statement, policy remains accommodative. The degree of accommodation I would characterize as moderate. As I've emphasized and said in the statement, we currently judge the neutral level of the federal funds rate to be pretty low. So there is some accommodation. Remember that inflation is still below our objective. The committee projects, at least the median projection shows, a very modest undershoot of estimates of the longer run normal rate of unemployment. The median unemployment rate here gets down to 4.5%, which is just a few tenths below the estimated longer run normal level of the unemployment rate. And we think that that's appropriate because we want inflation to rise to our 2% objective in a timely fashion. So there is not a substantial undershoot of the natural rate of unemployment. We're not seeing evidence in labor markets of very substantial upward pressures on labor that could signify extreme shortages of labor that could propel inflation higher in a very rapid way, and inflation is still operating below our objective. So I do not judge that we are behind the curve. My judgment is that we're in a good path to reaching our objectives, but of course the outlook is uncertain. We recognize that there are many sources of uncertainty affecting the outlook, and we will have to adjust our thinking as things evolve, as conditions evolve, and we learn more about economic policy changes that could affect the outlook.
Jim Tankersley, Washington Post.
Chris.
I'm curious, you and your predecessor had both at times called for more fiscal stimulus to help with the outlook, the growth outlook. And I'm wondering, how much do you judge the economy has capacity for fiscal stimulus right now? It's a version of Steve's question, but I think we're trying to get at how much can happen before we run that risk of overheating?
Well, I believe my predecessor and I called for fiscal stimulus when the unemployment rate was substantially higher than it is now. So with a 4.6% unemployment and a solid labor market, there may be some additional slack in labor markets, but I would judge that the degree of slack has diminished. So I would say at this point that fiscal policy is not obviously needed to provide stimulus to help us get back to full employment. But nevertheless, let me be careful that I am not trying to provide advice to the new administration or to Congress as to what is the appropriate stance of policy. There are many considerations that Congress needs to take account of, and many bases for justifying changing fiscal policy. I've continued to highlight the importance of spurring productivity growth, that I think that would be something that's beneficial for the economy. Of course, it's also important for Congress to take account of the fact that as our population ages, that the debt-to-GDP ratio is projected to rise, and that needs to continue to be taken into account. And so there are many factors that I think should enter into such decisions.
Chris, and then Lindsay.
Thank you. Chris Condon, Bloomberg News. Chair Yellen, you've just spoken about some of the risks, the inflationary risks of running an expansionary fiscal policy. But in October, you were wondering about whether it might be possible to repair some of the damage done to the labor force during the recession by running what you termed a high-pressure economy. So I'm wondering, why couldn't fiscal policy serve the same end in seeking to run a high-pressure economy, hoping to draw more Americans off the sidelines and into the workforce. Is there something necessarily riskier about approaching it from the fiscal side, or perhaps have you become less enthusiastic about the idea of running a high-pressure economy? Thank you.
So I want to be clear that what I said in that speech in Boston is that an important research question is whether or not in an economy with a very strong labor market, there might be changes that took place that permanently raise the labor force participation, training, and other things of the labor force that would be positives for the productive potential of our economy on a long-lasting basis. I never said that I favor running a high-pressure economy, and as you can see in the SEP projections of the participants, and this has long been true not just in this forecast but in earlier ones as well, you see a modest undershooting. The unemployment rate is projected to modestly undershoot for several years, levels that are deemed to be normal in the longer run. That's an appropriate policy purely on the grounds that inflation is running below our objective, and while we don't want to overshoot our 2% objective, we also don't want a persistent undershoot of our 2% objective. And that does involve a labor market that may succeed in attracting more people off the sidelines into the labor market. It's something we will see as we examine experience over the next couple of years. We may adjust our views on this, but I do want to make clear that I have not recommended running a hot economy as some sort of experiment.
Hi, Lindsay Dunsmuir with Reuters. How comfortable are you with possible interference on Fed policy by the incoming president? And I'm talking there about the negative impact his tweets on aerospace companies in the last week have had on their share prices. And do you feel having a president tweeting about individual companies, do you feel that that could begin to distort corporate decision-making?
Well, I'm not going to offer the incoming president advice about how to conduct himself in policy. I'm a strong believer in the independence of the Fed. We have been given the independence by Congress to make decisions about monetary policy in pursuit of our dual mandate objectives of maximum employment and inflation. And that is what I intend to stay focused on. That's what the committee is focused on.
The president-elect has said that overhauling financial regulation is a high priority for him. I'm curious whether the Fed has been asked to provide any advice on how that might be done, and what advice you would provide to the president-elect about how our financial regulatory system should be improved.
So our staff have been in touch with the Trump transition team, and we, of course, share the objective that the whole government has to work constructively to ensure a smooth transition. I've not been in touch beyond that, and it's not something that I would expect. I'm sorry, so would I...
About how the system should be improved?
About how the financial rate, yeah. So, okay, on financial regulation, I feel that we lived through a devastating financial crisis that took a huge toll on our economy. And most members of Congress and the public came away from that experience feeling that it was important to take a set of steps that would result in a safer and stronger financial system. And I feel that we have done that. That has been our mission since the financial crisis for the last 6 or 7 years. That's what Dodd-Frank was designed to do. I think it's very important that we have reduced the odds that a systemically important firm could fail by requiring higher capital, higher liquidity, by performing stress tests that provide us another way of ensuring that the firms we count on to supply credit to households and businesses would be able to go on doing that even in the face of a severely adverse shock. The firms, the largest firms, have a great deal more capital than they did before the crisis. Those are important changes. We have placed the toughest regulations on those firms that are systemically important. I would advise that, and we have been trying to do this, that it's important to look for ways to relieve regulatory burden on community banks and smaller institutions, to tailor regulation so that it's appropriate for the systemic risk profile of the particular institutions. I think there was broad agreement also that we should end too big to fail, and that means not only reducing the odds of the failure of a systemically important institution, but also making sure that should such a firm fail, that it could be resolved in an orderly way. And the living wills process has been about that, and I think we've made considerable progress in making sure that the largest and most systemic firms conduct their businesses in a day-to-day way with some thought about, with important thinking in place about whether or not the way they're conducting their business would aid resolution in the event that they encountered a severe negative shock. So this is progress. I would say it's very important not to roll back. There may be some changes that could be made, and we've suggested a few, like eliminating the burden of compliance with the Volcker rule or incentive compensation regulations for smaller banks, or modestly raising the threshold for banks that are subject to enhanced prudential supervision. But I would urge that it's important to keep this in place.
Marty and then Nancy.
Marty Krutzinger with the Associated Press. The election of Donald Trump seemed to spark a major reaction in financial markets. Stock prices at record highs. The dollar has strengthened. Long-term interest rates are higher. Did any of that get discussed in the meeting, and do you feel that it will have any effect, either negative or positive, on things? And also, did you have any broader discussion about Trump's economic plan and what it might do and how the Fed might have to react?
So we did discuss these topics in our meeting today. I would simply summarize by saying that all the FOMC participants recognize that there is uncertainty about how economic policies may change and what effect they will have on the economy. And insofar as that will affect monetary policy, of course we will have to factor those policies along with many other things, including the global environment and oil prices and other matters. We will have to factor that into our outlook and figure out what is an appropriate response. But we're operating under a cloud of uncertainty at the moment, and we have time to wait to see what changes occur and to factor those into our decision-making as we gain greater clarity. You mentioned the market moves. So I see the market moves as implicit forecasts about what impact these policies are likely to have on the economy. The changes, the financial market changes that you described, particularly the increase in stock prices, the increase in longer-term rates, and the strengthening of the dollar, suggest that many market participants anticipate expansionary fiscal policies that would raise interest rates somewhat in the United States relative to abroad and would cause a strengthening in the dollar. But market participants are uncertain too, and I would expect changes in our understanding of what is going to happen to also affect market prices in financial markets as we move forward.
Hi, Nancy Marshall-Genzer with Marketplace. Wondering about Slack. When do you think the slack in the labor market will have worked its way through, so we're no longer talking about it at press conferences and it's not such a big issue?
So this is not something that it's possible to judge precisely. My colleagues write down their best estimates of a normal longer-run unemployment rate. The median stands at 4.8%. So we're close. Possibly the unemployment rate right now is ever so slightly below, but in the neighborhood. If we look at larger, broader measures of slack, like the U6 measure that includes involuntary part-time employment and those who are marginally attached to the labor force, they're slightly higher than pre-recession levels, but they've come down considerably. We look at a broad array of indicators of the labor market, and if you look at job openings or the hires rate or the quit rate or difficulty of hiring workers as reported in business surveys, I would say the labor market looks a lot like the way it did before the recession, that we're roughly comparable to 2007 levels when we thought there was a normal amount of slack in the labor market. The labor market was in the vicinity of maximum employment.
Thanks, Mike. And then we'll go to Peter.
Michael McKee from Bloomberg Television and Radio. Given President-elect Trump's criticism of your low-rate policy during the campaign, like it or not, market participants are going to focus a lot in 2017 on you. You've suggested you will serve out your term, but I'm curious if that statement still holds, if you would like another term as Fed chair, if you would accept another term as Fed chair, and would you stay on the committee if you were not Fed chair?
So I guess the way I think about it is that I was confirmed by the Senate to a 4-year term. The term of the Fed chair was not meant to coincide with that of the president, and there were good reasons for that too. It's part of ensuring the independence of the Fed, and so I do intend to serve out my 4-year term. I haven't made any decision about the future. I recognize I might or might not be reappointed. It's a decision that I don't have to make and don't have thoughts on at this time. And she said, I recognize too that I could stay on as a board member, and that's a decision for another day.
Peter Barnes, Fox Business. Just to follow up on Marty's question about the financial markets, the Dow is about to hit 20,000. It's up substantially since the election on apparently investor optimism about potential the impact of President-elect Trump's policies on the economy and an improving economy. I wonder if you share that optimism, number one, and if not, are we seeing a bout of perhaps irrational exuberance right now, or are you concerned at all about a bubble in equity prices that could create some financial instability in the economy? So,
I really don't want to comment on the level of stock prices. They may have been boosted by expectations about tax policy, possible cuts in corporate tax rates that have been much discussed, or by expectations about growth, possible reductions in downside risk to the economy. But these are things that market participants are trying to view along with the likely paths of interest rates, and I think all of that factors into movements in stock valuations. But I don't want to offer a view as to whether they're appropriate. And
you have mentioned in the just follow on equity prices, you have talked about whether or not the valuations are still are within historical ranges and norms. Is Dow 20,000 kind of within the historical norms? Are you comfortable with that?
Well, I think rates of return in the stock market relative to remember that the level of interest rates is low, and taking that into account, I believe it's fair to say that they remain within normal ranges.
Go back to John Helton.
John Heltman with American Banker. You said that much progress has been made since the crisis in making the banks more secure, more safe, higher liquidity, capital levels, et cetera. Does that feeling extend to the culture of the banks, the way that they run, the way that they operate, and their approach towards business? Do you think that more needs to be done there? Do you expect that if there has been improvement, that it will continue to be, that culture will continue to improve in the next administration and the next Congress?
Well, there have been many ways in which there have been compliance failures at large organizations, and you've seen a series of enforcement actions by the banking regulators over a range of practices that suggest some breakdown of compliance or culture, whether it involves violations of sanctions or foreign exchange or LIBOR or other matters. So this is something that we've discussed and emphasized the importance of a culture of compliance, and the board will be undertaking a review. We've already begun this year broadly of compliance and management of compliance risk in the largest corporations. So I think this is something that's important, and the failings that we have seen in a number of institutions suggest there's certainly room for improvement.
Greg Robb and then Patrick.
Greg Robb from MarketWatch. I'd like to two questions, if I might, follow up on the question about running the economy hot that you mentioned in your speech up in Boston a couple months ago. You brought it up. Are you now sort of distancing yourself from the idea?
Well, I want to make clear what I said and what I didn't say. One of the things we learned from our financial crisis and from a series of financial crises in history and around the globe is that very commonly when the economy takes a hit and falls into a recession, that productivity doesn't pick up to pre-recession levels, and that there looks like there is a permanent hit to the path of potential output for the economy, which is called hysteresis. And I raised the question as to whether or not this might operate in the opposite direction as well. We have seen quite a few people who lost their jobs during the Great Recession, drop out of the labor force, and lose their ties and become discouraged and not reenter. And I raised a question as to whether or not hysteresis could operate in the opposite direction. And that was a research question for economists to see if there is any evidence, because it could be important in determining policy. But I didn't draw any policy conclusions from that. And as I indicated, I think the path that you see that the committee has laid out in a tentative way that involves a modest degree of undershooting of normal longer-run levels of unemployment, going down to around 4.5%, where it would remain for a couple of years, might provide some insight. So I was not recommending a substantially easier policy in order to test that hypothesis.
I guess my question that I had before that follow-up was, both times you've raised rates in this cycle, the market expectations of a rate hike have been over 50%. The market has, kind of priced it in. Is that a prerequisite going forward? Will that have to happen as you go forward, Todd? It's
not a prerequisite, but we do try to explain our evolving views as clearly as we can. It's important for market participants to have a sense of how we think about the economy and the appropriate path of policy to look at incoming data and to form their own judgments as to whether or not changes in policy would be appropriate. And while it's not a prerequisite, if we're in good sync in terms of explaining what goes into our policy judgments, it's not surprising that it would often be true that moves are well anticipated by the market. As I said, in thinking about today's move, we've indicated that we thought we were making progress on our objectives. We wanted to see some more. I think anyone looking at incoming data can clearly see that we have enjoyed further progress both in the labor market and on inflation, and therefore there are good reasons why the market should have anticipated a move today.
Chair Yellen, Patrick Gillespie with CNN. There's been a lot of discussion about manufacturing jobs and trade. I'm wondering, what do you think are 2 or 3 concrete steps that could be taken to increase manufacturing employment in the United States? And separately, I've asked you about the importance of job training programs, something that you've emphasized. Specifically, what do you think about the worker assistance provided to workers who lose their jobs to trade, both the financial assistance and the worker retraining programs? Are they sufficient?
So I don't want to weigh in. I don't intend to weigh in. I haven't weighed in on either fiscal policy specifics of evaluating policies. I'm not going to weigh in either on the details of particular trade policies. But more generally, I'd say you asked me about manufacturing. There were a lot of manufacturing jobs lost over a long period of time, and particularly during the Great Recession. We've had some recovery in manufacturing employment as the economy's recovered. So to some extent, manufacturing employment depends on the progress of the economy, and we have seen some recovery. Over a long period of time, technological change is something that has been important in reducing manufacturing employment, absolutely, and as a share of jobs in the economy. For decades, the pace of technological change in manufacturing has outstripped that in the economy as a whole. And so manufacturing firms have found it easier to continue producing with reducing their workforces, and that's a change that I would expect to continue. You mentioned worker assistance. So some of the forces that are acting on manufacturing and other sectors, including technological change and globalization, even though most economists would judge the overall consequences of these developments for the economy to be positive, certainly there are groups of workers who were harmed by developments pertaining to globalization and technology. And I think most economists and policymakers recognize that it's important to provide ways for workers who are harmed by these kinds of developments to be retrained for jobs so that they can succeed in the economy. And so, I mean, I would agree, without getting into any particular program and whether it's sufficient, I do think that it's important to recognize there are those who are harmed by these developments, and their concerns, I think, need to be addressed by policymakers, certainly.
Justine Underhill, Yahoo Finance. So the Fed's balance sheet has grown to over $4 trillion. And as the Fed begins removing policy accommodation, under what circumstances would you see the Fed removing or possibly winding down its balance sheet and either letting securities mature or possibly outright selling bonds from the SOMA portfolio?
So we have indicated in our normalization principles that we expect to diminish the size of our portfolio over time, largely by ceasing reinvestments of principal rather than by selling securities. We've indicated that once the process of normalization of the federal funds rate is well underway, we would probably begin to allow our portfolio to run off. We've not yet made any precise decisions about when that will occur. We want to feel that if the economy were to suffer an adverse shock, that we have some scope through traditional means of interest rate cuts to be able to respond to that. Now, there's no mechanical rule about what level of the federal funds rate we might deem appropriate to begin that process. It's not something that only depends on the level of the federal funds rate. It also depends on our judgment of the amount of momentum in the economy and possible concerns about downside risks to the economy. So we've not yet made this decision, but it is something that we have long planned to begin to allow our balance sheet to run off, and then it would take several years, and we would end up, if all goes well, with a substantially smaller balance sheet than we have at present.
We'll go to Mike Derby for the last question.
Mike Derby from Dow Jones Newswires. I wondered if the unexpected outcome of the election and the sense that a lot of people are really upset with how the economy is performing, despite having aggregate economic statistics that look pretty good, is that causing you in any way to think differently about how you evaluate the economy, like what sort of things you look for to get a sense of what's going on in the economy? Basically, did how things turned out in the election, is it making you think differently about how you evaluate the economy's performance and how it's doing?
Well, I mean, we've long been aware, and I've spoken about previously, disturbing trends in the economy, particularly rising wage inequality, income inequality, and the fact that a significant share of our population hasn't been enjoying significant real wage gains, if any. And so these are long-standing concerns. These are not new phenomenon, but the recession was very severe and probably exacerbated developments that had long been affecting many American workers and households, and I think they are quite disturbing. Now, they're ones that the Fed is not well positioned. I think our policies can affect the general level of economic activity and slack in the labor market, the level the rate of inflation, which we focus on, but I think it's important for policymakers more broadly to be attentive to these trends and to think about policies that could address them. We have been quite attentive with respect to particular demographic groups in the labor market, particularly minorities tend to be very badly affected by downturns. We've discussed that. We've been focused on it. It's not just since the election, and are pleased to see that they are enjoying gains. For example, the African American unemployment rate at this point is now about back to 2007 levels as well. But these are important trends, and I think it's important for policy to address them.
Thank you very much.
Chair Yellen's announcement at the start of this news conference that interest rates increasing by 0.2